Now, U.S. businesses, of course, they may still be leery of hiring because of the economic climate, and there are concerns about contagion from Europe's debt crisis. The G7 nations, they're due to meet in 2 days, while today a U.S. Treasury official urged European leaders to take decisive action to prevent the crisis from spreading. All right, let's talk about this with our guest. We have Stephen Brown. He is the Vice President and Portfolio Manager at American Century Investments. Also with us, John Mauldin. He is the President of Millennium Wave Advisors, and Michael Woolfolk, Managing Director, Bank of New York Mellon. Also with us, we have our Senior Markets Correspondent, Julie Hyman. John Mauldin, I want to begin by asking you to talk a little bit about Endgame. This is your book, Endgame, the end of the debt super cycle and how it changes everything. Give us the context for the president's speech. These are issues bigger than just one term.
The problem that this president has, or a Republican president has, will have in 2012 and 2013, is that you're fighting headwinds. We are in a deleveraging, deflationary recession. We're either going into it or we're at it now. But that's the headwind. And as I wrote in last week's article, we've got to add something like 200,000 jobs a month just to get back to where we're wanting to be in 4 or 5 years. That's not going to happen. So presidents and politicians can talk about doing something all they want, but what they've really got to do is get out of the way of entrepreneurs and small businesses and startups, because that's where new jobs come from. So you can have all the stimulus you want, but it's pushing on a string, which is what we found out with the last stimulus, which is what we found out with QE2. The president, if he wants to be judged on providing jobs, he's going to get a D on his report card. If I were the president and I was his advisors, I'd be saying, let's figure out something else to be judged on, because you're fighting an uphill battle with the economy. It's not just Democrats, it's whoever's in charge.
Michael Woolfolk, this idea that we're in a deleveraging cycle, the debts, they're coming due, and we've been piling them on for many years.
Well, certainly. And look, we know nothing different than we did several months ago. I mean, certainly there is quite a bit of debt overhang. Savings rate, on the other hand, is improving. Savings rate now is about 5%, has been 5% for the last 6 months, which is certainly well better than it was before the Lehman crisis, before the deleveraging started. I think that the point I'd like to make is that even though this is America, the home of democracy, not all stimulus measures are equal. And certainly QE2 had middling success. QE3 likely would have middling success as well. And in terms of finding one metric to be judged on, I agree with your guest that the metric should be jobs. I think it's going to be all about jobs for the coming election, and perhaps inflationary effects would have to be put to aside for the time being. It is about jobs. We can create enough jobs. The administration has a good shot at being reelected.
Stephen Brown, the idea that the economy is stalling right now, true?
Yeah, we think the economy's been slowing down and the leading economic indicators have been rolling over. So we think the third and the fourth quarter this year will be tough ones for economic news. So we've got that. We still have high oil prices and high food prices, which are having a negative impact on basically 80% of the country in terms of their disposable income. I think what the president's going to say Thursday night is starting to get priced into the market, and whatever spark it creates will probably be over in a couple of days as we get through to the economic data that's coming out for August and September, which will be more evidence of a slowdown. I would say, though, that as we move into an election year, the possibility of other stronger or more dramatic policy measures are out there that could have a short-term impact on the market.
Julie Hyman, today's market move, a lot of people buying stocks from your reporting. Is it in anticipation of the president's speech?
It's at least partly in anticipation of that, although, as we've been talking about, it's perhaps already partly priced into the market. What's interesting, too, is as we've been talking to investors and saying, what can the president do? Does he actually have any measures at his disposal? One of the big themes that we're hearing a lot about is for the president to pull back on regulation, to either suspend regulations that are in place or to stop them entirely. It's unclear, though, what effect that would actually have on corporate hiring. On the large level, we've heard the same thing from CEOs. They'd like less regulation. regulation. When you talk to small businesses, there's less evidence there that regulation is really the issue behind them not hiring. The issue really seems to be end demand, that there's just a lack of it. So it's still unclear what he could say that we don't know already that would surprise the market and help it go up.
John Mauldin, come into this idea of the debt super cycle, because you talk about the big issue is getting the debt of the United States down to a manageable level. What have we learned about what's going on in Europe right now? Why does Greece matter to the U.S. debt problem?
Because Greece is a map of what the world will look like if you don't solve your debt crisis. Now, we don't need to solve it all at once. I was talking with some Tea Party senators, a bunch of senators, in a private conversation about 3 weeks ago. And I was telling these guys, we can't solve it all at once like you want to. You've got to do it 5 or 6 years over time. But that's $150 to $200 billion a year. And that puts a headwind of 1% of GDP on the economy. We are locking in a slow growth economy, or we're going to hit the wall like Greece, in which it's even worse. The most important thing that should be facing every senator and congressman is fixing the deficit. And, you know, as a Republican, using the words tax and increase in the same sentence makes me just shiver. But the reality is that even more important than not having, ideological purity and not having a tax increase, it's more important to solve the deficit crisis. And we can do that between a combination of potential tax increases and a lot of cuts. But that's got to be over 5 or 6 years. And it's just the nature of the cycle that it's going to be a slow growth economy when you do that.
Michael Woolfolk, a slow growth economy, but as John Mauldin says, an ability to cut the deficit.
Well, absolutely.
And the debt.
We have to prioritize here. And again, first off, we have to start with jobs. Jobs for jobs' sake. The second thing is
but where's that money going to come from? $300 billion.
Well, we're going to be facing higher taxes eventually.
Okay, higher taxes for jobs programs.
And it's going to happen across the board. But that is well after we get through this current economic down cycle. We have to focus on jobs. The election is a distraction, although certainly the outcome of the election is anyone's guess. But jobs, growth is the next thing we have to focus on. After we get growth, then we focus on the debt, because without growth, as we're seeing in Greece, and I think that's the lesson in Greece, if you don't tackle this problem well in advance, it becomes so large it cannot be resolved. And right now, I don't think there's a solution to Greece.
John Mauldin, go ahead.
Let me come. The problem with that is if you don't tackle the deficit, you become Greece. We're already getting close to the end game. I don't think we can go much past 2013, 2014 before the market starts looking around and saying, you guys aren't being serious. Now,
let me just bring in Stephen.
I recognize that
Let me just bring in Stephen. I want to ask you, when you talk to investors right now, are they saying the same thing? We've got to tackle these problems now?
Well, I think they have concerns about it, but I would also make the case that as we get closer into the election year, I think the priorities will change in Washington, so it'll be more focused on creating jobs and economic growth and backpedaling on the deficit reduction, because the current administration is going to put a lot of emphasis on getting reelected, and they're going to focus on jobs and economic stimulus. And I just believe the deficit reduction, while I understand the importance of that, is going to be pushed back at the expense of that.
All right, we're speaking about jobs, the global economy, what to do with your money. Europe, for example, it struggles to find ways to control its sovereign debt crisis. The G7 nations, finance ministers from the G7 industrial nations, they're meeting later this week in France in order to discuss this crisis. My guests include John Mauldin. He's the president of Millennium Wave Advisors. Also with us, Michael Woolfolk, managing director, Bank of New York Mellon. Our senior markets correspondent, Julie Hyman. And joining the mix now, we have Domenico Lombardi. He is a senior scholar at the Brookings Institution. Gentlemen, I just want to bring in you, Michael Woolfolk, because something that Julie Hyman was describing during the break, the idea being that when S&P downgraded the long-term debt of the United States, people were all rattled about that move, and yet what has happened since? People have been buying up the 30-year Treasury bond as if it's going out of style. What does that mean?
Take a look at the long end of the curve. I mean, it's considerably lower now, with the 10-year yields now below 2%. Remarkable development. Obviously, the market shrugged that off. S&P is under a lot of fire for that decision, and other credit rating agencies, Moody's, Fitch, have not followed through. So even if they did, I doubt that it have much impact. The U.S. dollar in U.S. debt market are truly unique. And perhaps it's a reflection of the fact that the market believes in the U.S. and the U.S. ability to overcome this difficult place right now.
Julie Hyman?
Pimm, what I would also add is that it also seems to reflect, even though the market is supposed to be a discounting mechanism, it doesn't discount that far out. I mean, if you look at what's happened in Europe, the markets there didn't really start to deteriorate until the situation there got to sort of a tipping point where people were very concerned. So I wonder if we'll see the same situation in the U.S. markets, where the U.S. Fiscal situation will have to become very dire before you really start to see investors, certainly in the equity markets, start to respond.
Domenico Lombardi, pick up on that. Do you think that the United States is staring a European debt crisis in the face?
Well, I think, the United States situation is completely different from Europe. The United States is carrying, a substantial fiscal deficit and increasing public debt. There was, yes, a downgrade, but yet the potential rate of growth of the United States economy is high, and certainly far higher than many continental European economies. Moreover, in Europe, we have, a monetary union, which is not, however, a fiscal union, nor it is a political union. And of course, this creates a whole range of uncertainties about, what kind of policy response the European policymakers will put forward. And I think this is really an important component that explains, a lot of what has been going on, besides the fact that many European economies have been growing at a very low rates, and certainly one of them is Italy, which is expected to grow this year and next at a rate around 0.5%. I mean, certainly not enough to sustain its 120% debt to GDP ratio, should this rate, be extrapolated going forward. And therefore, the range and the nature of problems is fundamentally different. So is the prescription as well as the ultimate assessment.
John Mauldin, how do you respond to that? That the issues related to Europe, they're really unrelated to what goes on here in the United States. We're not another Greece.
Only to the extent that we deal with our deficit. We eventually become another Greece if we don't deal with it. I happen to think we will. I think the realities of the problem that will face Congress in 2013, they'll deal with it. That being said, we have to do that. Japan's got their own problems. Europe has had its own set of situations. I think Europe is going to have a real kind of, to use a Southern Baptist expression, a come to Jesus moment. They're going to have to decide whether they want to be a fiscal union, and whether some of the smaller countries want to give up sovereignty, which looks like that could be difficult, or whether the ECB wants to print and Germany goes along with that. Right now, the only reason that Italian and Spanish debt hasn't blown out to the upside is that the European Central Bank is buying their debt, and they're holding the rates down. If that buying were to go away, interest rates would begin to rise again, and you would see a crisis in Spain and Italy. Europe's got to figure out how they're going to deal with this. It's not altogether clear to me from reading the polls and looking at the tea leaves what they're going to do. Breaking up the European Monetary Union, leaving it, whether you're a strong country or a weak country, will be extraordinarily difficult. It has the potential for all sorts of crises if somebody actually decides to go down that path.
All right, let me bring in Michael Woolfolk, because Michael, you've got a thought about if Greece, for example, were to leave the European Union. You say maybe this would be good for the tourism industry.
Yeah, absolutely. I think that you have to make a distinction between who in the European Union leaves. Does Greece leave? My analysis is if Greece leaves, the euro could actually benefit. It's as weak as its weakest link, and not only would the Eurozone benefit from this, but actually Greece would. The reason why Greece is not the United States, Greece has a much less diversified economy, tiny nation. It's very much dependent upon tourism, and they're in a cycle now where they can't increase tourism unless they devalue their currency. They have to exit the Eurozone. That's how they're going to get out of this.
We've got to leave it there. I want to thank you very much. Michael Woolfolk, John Mauldin, Domenico Lombardi, and our own Julie Hyman.